All right. So this is Regions Financial stock valuation. The reason behind this is because I was looking at purchasing more shares to average costs down our price, which is currently at 26 bucks. The current price on Regions Financial is 19 and change. And so um, what we're looking at is, like I said, purchasing 100 more shares and to see if we can get our costs down a little bit. Um, this was a really interesting valuation. The numbers I got were so crazy that I went and grabbed two of their competitors just to make sure that everything was legit. So right away, just to get into it, of course, my earnings per share as well as my book value was a little different than what you'll find online. I think I talked about that before. The lowest book value that I found was right at 0.65 of book value, which is really low. The problem with that number, though, is that this was the COVID low, and so every bank that I looked at had this same drop, and so also decreased the book value as well. So I went ahead and used it. Whether or not that low will ever come up again, I seriously doubt it. But it's in there just for reference. The other thing to mention is that for the banks, what I come to realize is that when I started looking at book value, the biggest thing was their loan portfolio. Okay, now every bank has what they call allowances for losses, meaning that they pretty much have an idea of how many loans are not going to be paid back, right? They have an idea of how many people are not going to pay their credit cards, and they already put that on the books. Like they know that this is going to happen. If it doesn't happen, great. If it does, they've already accounted for it. Okay. In my calculations of book value, I'm not assuming that the best case scenario is exactly what they planned. Okay. I'm still going to discount that loan portfolio by quite a bit. And so I discounted it 15%. And basically, I did that just so that I can get a book value. I mean, anything discounting it any more than 15%, and all of a sudden, the book value is zero. The other thing that I had to do again just to get a book value is I had to assume that if in fact this company were to go bankrupt, they will be able to sell their treasury shares on the open market before they went bankrupt. There's typically a bad sign in the stock market if a company has to reissue shares or sell shares from their treasury. But again, I'm assuming worst case scenario, that's what they would do. I also figured that currently the price is right around 20 bucks. So I figured that they would sell those shares for about $10 a share. Again, just coming up with something in order to give me some sort of book value. Okay, and so that's what you see over here in the first column. The conservative estimate gives a book value of $3.70 a share. Once you put a multiplier on it, based on again historical book value, you get these numbers here. Currently, the book value is 1.13. Typically, a bank will stay at about a 1. Anything below a 1 is typically a sign to purchase the bank, unless there is some huge problem with the company. Anything below a 1 is a for sure buy signal. And then the historical high on this particular company is 1.45. And so that's what you see here in the bottom corner here. All right. So for the moderate for the moderate situation, I used roughly, was it 90? Yeah, 95%. So I discounted the loan. I discounted the loan portfolio 5%. I also discounted things like um, other assets, right? I didn't want to dive too deep into what those other assets were, but again, this is assuming worst case scenario. If they had to sell these things on the open market, let's discount them at least 5%, so that we can get an idea of what the company is really worth. And so that's what you see here at the bottom. And then using the actual numbers from the balance sheet, we get a book value of $23.50 a share, which actually means that the company is undervalued. And then once we put a multiplier on that, at the current book value, we have a stock price of 26.55. Like I said, currently the stock price is like 19.70, and so that gives me an undervaluation. At the highest book value, we have $34, which I don't expect that to happen. But again, it is a range just for us to kind of look at. I do want to show too down here what I did was I did just an average of well, not all of the numbers. I did an average of the moderate and the actual numbers, and it gave me a stock price of $20.95. And this is assuming all of the different variations in book value. Okay, and remember, I said before, but book value has a lot to do with market sentiment, right? It's just what the market values banks at that point in time. People may get really excited about banks, and so book value will shoot up. People may get really scared about banks and sell a lot of the bank stocks, and so book value will come down. So again, this is just a range of historically what it's been over the last 5 years. Okay. All right. PE ratio. This is a price to earnings. This is coming from the income statement. So the price to book is the balance sheet. Price to earnings is the income statement. All right. And so what I did was I grabbed just the last 12 months. So everything from June 2021 going back to June 2020. I just grabbed the earnings from there to give me an idea of what their earnings are. Now, am I trying to guesstimate what their earnings will be? No, I'm not. I'm just saying this is what the earnings were. Okay. And then what I'm doing is I'm putting a standard deviation on those earnings. Standard deviation is literally saying what is the difference in earnings from quarter to quarter. All right. And whatever that difference is, we're going to assume that, okay, well, next quarter, it may go up by this much, it may go down by this much. Okay. And so that's what you see here. Now, the current earnings per share, I didn't pull this up, but it is different from what I have. Okay. And a lot of that has to do simply with the number of shares. Okay. Because price to earnings has a lot to do with the number of shares. And remember, I said that the company has treasury stock. And so if you go to Google Finance, Yahoo Finance, or whatever, they're going to calculate the earnings per share based on the total number of shares issued. Okay. The problem with that calculation, though, is that a portion of those shares issued, the company actually owns, right? And so they have the ability to sell those shares and bring more money in. And so when I'm looking at the number of shares, I'm looking at the number of shares actually available on the market, right? If the company owns those shares, they can retire those shares, okay? And so my earnings per share is going to be a bit higher than what you'll see, like I said, on Google Finance, Yahoo Finance. And so anyway, based on that, I have a conservative. No, I'm sorry. This is the moderate. Yeah, so it's the moderate earnings per share, $4.19. And then the PE ratio. Again, this is a historical low. All right. And the current PE ratio is 7.8. My PE ratio is what is it? 6.28. Make sure I got that right. Yeah, the current PE ratio for Regis Financial is 7.8. The PE ratio that I came up with was 6.28. All right. And so what I did was, in order to make sure that my PE ratio lined up with the earnings per share that you'll find on Google Finance or whatever, I basically just I kept the same ratio. All right. So it's equal. All right. So even though it's a different number, it's still equal relative to the actual PE ratio. So anyway, on the low end, PE of roughly 4, okay, puts the current stock price at $16.52. Again, that's the historical low for the last 5 years. So that means if sentiment just turns horrible, and again, we're talking about the COVID lows at this point, okay, then the stock price is currently valued at $16.50. Currently, I'm showing the price at 1971. That's what it actually is, okay. And then on the high end, we have a stock price of 67.44. The interesting thing about this high end PE ratio is that if you and I don't have this queued up, but if you go back and look at the history of the PE ratio for Regions Financial, it's been in the 20s more than a few times, and so you know, whether or not that's going to happen again, I seriously doubt it. But it's a possibility. It's a possibility, definitely a possibility. Um, and so anyway, on the high end, at the P ratio 19, 22, 77, and then this is on the low end, okay, so 14, 16, and 57, and then down here we have an average of $37.20, which again makes the stock price very undervalued. All right, and so again, seeing this, I was like, man, this is way undervalued. You know, if the price is 19 and I have 20 and 37, like that's a huge gap. So let me take a look at some of their competitors and make sure that you know, these numbers are legit. So I pulled out Truist, which is actually a larger company than Regis Financial, but they pretty much, you know, they're pretty much in the same business. For this one, I actually my yeah, my PE ratio is actually exactly what you'll find, like I said, on Google Finance or Yahoo Finance. It's only off by like point two, I think, or something like that. I think the current PE for Regions Financial is like 14.7 or something like that, and I came up with 14.5. So for me, that was just proof of concept that my calculations are correct in that regard. So I didn't have to put any sort of multiplier on it in order to equate it to the actual PE ratio. Again, I did have to play around with the treasury shares in order to even get a book value. Same thing for Regions Financial. The treasury shares for Truist, though, it was a huge difference. They have issued was it like 250 million shares, I think it is, but there's only currently like 130 something million out there. And so the rest of those shares are just sitting on the company's books. They can sell them if they want to. They cannot. Currently, the price is at 56, and so again, I'm assuming worst case scenario, if they had to sell these shares on the open market before they went out of business to get some cash in, I'm saying that they'll sell them at roughly $10 a share. Now, whether or not that'll actually happen, uh, who knows? I mean, how far does the share price have to fall before the board takes such drastic measures as that? I don't know. But again, that just gives us a range to look at. Okay, so I have a per share price of $2.62 in that regard for our moderate situation. We have a stock price of $10 per share. You throw a multiplier on that, and we still have a really low number here. Come over here to the actual number. These are the actual numbers reported on the balance sheet, and the stock price is still only 34.57 per share. Even when you throw a multiple on it, okay, the current price to book is 1.22. That gives you a stock price of $42.18, which means this company is very overvalued by quite a bit. You know, the stock price, like I said, is 56, and I'm calculating $42. On the low end, 22 bucks, and on the high end, 62. And it does need to be said that the high end of their price to book is not far off from the current price to book. And so I guess that kind of makes sense as to how we get to a stock price of $56, right? Because it's really not that far off. But if you look at the just straight up math calculation at 1.22, company's only valued at 42 bucks. So that's way under what the actual price is. All right, for earnings per share, let me see. I think, was there something weird with this one? No, it's nothing weird with this one. All right, so earnings per share. Right now, like I said, the stock is 56.45. That's at the current PE ratio. The PE ratio has been 20 in the past 5 years, and so that gives us on the high end 77 bucks, and then on the low end 27. Again, this low end is the COVID low. Seriously doubt we get back to that. On the high end, 58.69, which is just a bit above where we are now. And again, this is earnings. So this is saying if next quarter the earnings go up by one standard deviation, the stock is then valued at 58.69. On the high end, if something turns in the market, $80, and then on the low end, 28. And then this is again, one standard deviation below the current earnings. If they happen to lose money in this next quarter, then the highest end is roughly 40 and goes all the way down to 15. On average, I got a price of $54.80. Let me also, because I did this with Regions Financial, grab the average on the book as well. Let's see what we get. Yeah, see. So again, I'm showing the company either way is definitely overvalued. And so again, that kind of gave me some confidence because if this company is showing overvalued, financially is undervalued, then I think those numbers are legit. But to be statistically significant, I wanted to at least get 3. You know, 1 time is luck, 2 times is coincidence, 3 times is a fact. Okay, so Wells Fargo, another competitor to Regions Financial, albeit a much larger company, much larger. Matter of fact, just to give some relevancy to this, Regions Financial is like 18 billion. Truist is something like 80 billion. And then Wells Fargo is 180 billion. So, of course, size does matter, right? You know, a lot of the larger companies will attract different types of investors. Larger companies are able to go out and buy up smaller companies and so forth. Also, it is, what's the word I'm looking for here? It's kind of a known thing, right? That smaller companies will grow faster than larger companies, right? It's harder to turn a big ship. Smaller companies are more nimble. These are not facts. This is just things that are being said. So take that into context too when looking at this stuff. But for Wells Fargo, again, I had to do kind of the same. Well, with Wells Fargo, actually, they are doing stock. That's a word sounds weird. Stock buybacks, and so every quarter their number of shares outstanding is different. All right, and so there was just no easy way for me to properly do that math. I thought about maybe just doing an average over the last 4 quarters or something like that. But what I did was I just took the current number of shares and just left it at that. Okay. Um, it does need to be said that for Wells Fargo, I did not have to do any playing around with selling treasury shares. I was able to get a book value even after discounting their loan portfolio by 15%. So right away, Wells Fargo is in a much better situation fundamentally than the other two companies that we looked at. Moderately discounted 10%, okay, which is again more than what I discounted the other companies. And I did that just because Wells Fargo can take it, okay. Um, so currently the price is $44 with a multiplier. We have 10 on the low end, 18, and then 27. And then what we have here at the current book value at 1.064 is $42.86, which makes Wells Fargo just a bit overvalued. But again, comparing that to the other two companies, Wells Fargo is less overvalued than Truist for sure. Okay. And then on the high end, $64, which I would say is pretty far away from the current book value at 1.06. All right, on the earnings, this one was a bit weird. Reason being is because Wells Fargo had a loss a couple quarters last year, and so just calculating the difference between actual earnings and the full year was a kind of a thing. But anyway, it is what it is. Got it done. The current where is it at? The current PE ratio for Wells Fargo is 12.66. Yeah, 12.66. And what I got was 14.55. All right. So not a huge difference. Not a huge difference. But my PE was a bit higher than what you'll find, like I said, on Google or Yahoo. And so because of that, I did use a multiplier just to make sure that it remained the same ratio, same relevancy, or whatever. All right. Current earnings per share, again, this is the last 12 months, not guesstimating the next quarter. 2093 on the low end, 44.17 is what the price is right now, and then 52.32 on the high end, which is not actually far away from their highest PE. So Wells Fargo can very easily make it to that 52, but I do think that in order for Wells Fargo to get to a PE of 17, I think the rest of the banks would have to also increase in PE as well. And so I think 52 is definitely going to be a cap. Anything even close to that, I don't think will happen. But you never know, right? All right. So on the high end, at the current PE, yeah, 52, which again is very close to the high end on the PE, and then 61.85, 24.74 on the low end. And again, this is assuming that earnings actually increase next quarter. And then on the low end, we got 17, 36, and 42. I got an average of 42.70 on the earnings. Let's see what we get on the book. I have to assume it's going to be somewhat similar. Let's see. 31. So again, this makes Wells Fargo overvalued, but like I said, not by a lot, and definitely not as much as Truist. Now, again, for me, proof of concept, if Regions Financial is undervalued, but both Truist and Wells Fargo are overvalued using the same math, then I have to think that the math is correct on Regions Financial, and we actually do have a situation where the stock price is currently undervalued. Currently, like I said, I have 26.55 on the book and 20.95 on the earnings. If earnings increase, again, like I said, we can go up to 22.72 fairly easily. So what I'm going to be looking at now is what the market thinks is going to happen. And the reason why this is important is because I want to make sure that whatever I purchase this thing at, I want to make sure that I can sell it at that 10% gain. All right, so let's blow this up. All right, so is this the calls or the puts? Okay, so this is purchase. All right, the other thing that I want to mention here is that I'm also conscious of dividends. All right, so Regis Financial just paid a dividend October 1st. Well, they will pay a dividend October 1st for people who own the stock as of September 2nd. All right. And so the next dividend is going to be paid out. Let's see if I can find this. Of course, there's no guarantee that it'll happen, but we don't expect them to cut the dividend. So the next dividend is payable January 3rd if you own the stock December 9th. And so that means that I want to make sure that if I am going to purchase more shares, I purchase it before December 9th, and so that I can get a benefit of an extra bit of money on the dividend. So November 2021 is the closest expiration date for an option. And so what I need to do is I need to purchase the stock at a price that will make it so that when I sell it at 10%, the price is not crazy. All right. So actually, let's go back and look at the calls. So this is what we can sell the company for. So, all right, here we go. Like I said, right now the company is at 1971. Someone is willing to pay $95 to sell that company at $20 by November. Okay, and so typically what that means is that they expect the price to be more than $21 by November. Okay, that's really what that means. Here, same thing. They expect the price to be more than $21.50 by November, and then so on. Where we see, and this is, wait a minute, yeah, this is November. Now we want to sell this thing. The furthest out we can go is February 2022, which I think again is going to be, yeah. So we'll miss that next dividend in March if we sell in February, but that's okay. We don't have another option. The next option is January 23. So take a look at what the options are. And so you see here, no one is willing to pay anything at $28. The reason being is because no one thinks the price is going to get there. Okay, no one thinks the price is going to get to $28 by February 18th. But there is a little bit of action on at $27. All right. And so the way that I do that math is I take that current price, $27, and I divide it by 1.1, which is 10%. Okay. And that tells me that I have to have this stock, I have to own it at $24.50. Okay. And then I can sell it at 27 for a profit, a 10% profit. If we look at the 26, I'd have to own this thing at 23.63. Now we currently own 500 shares at $26, and so we have to try to figure out at what price do we have to purchase this thing in order to own it at that roughly $24 mark. Make sure it's 26. Yeah, so roughly 24, $25. And then the other thing, just to go back, um, again, we have this thing evaluated at 26. Okay. And so based on my math, it looks like it can actually get there. Seriously. That's what the book value shows. And again, this is based on their balance sheet, right? So unless the balance sheet is going to change by a lot, then there's no reason why the stock price can't get to that 26, $27 range. Looking at the earnings, however, um, it's a little harder to say. I got it at $20.95. Just looking at everything. If I take the low end out and we assume that earnings is going to stay the same or grow, wait a minute. Oh, wait. This is the wrong one. Okay, yeah. If we assume that the earnings are going to stay the same or grow, then all of a sudden we have a price at 37.20. Again, that 37.20 though is assuming that PE ratios across the board are going to increase as well. So 26.55, 27, I think is a decent number. And so if we can get to uh, $26, okay, if we can get to $26, um, then again, we'll need to own the stock at 23.63. Call it 24. All right. And see, I did this math earlier, so let's see. Divide that by 600. It gives us 24.83, really 25. So we would have to purchase this thing. Yeah, we can't get there. We'd have to purchase this thing at looks like almost $16. Maybe $15. $14. Yeah, I mean barely. So if we were to somehow purchase 100 shares at $14, we would just barely get to the point where we can be profitable at that $26 range. Um, and so let's see if that's even possible. Let's go up to the $14 strike price. There we go. Puts. Remember, we want to try to catch the dividend. And let's see. And yeah, let me make sure I'm seeing everything. Wonder why it looks that way. Uh-oh, there's a ghost. How did that happen? All of a sudden, this is freaky. Okay, this is the options chain. Okay, so let's do this again. So November puts all of the monies Okay, there's a scroll bar. All right, load this up again. All right. So, um, no one is willing to sell us shares at $14. Not gonna happen. Um, and someone is willing to pay $10 to sell us shares at 15. But if we bought shares at 15, stock price would have to get to 26.58 for us to be profitable. I mean, listen, it's definitely possible. Um, the question then is 26.50. Let's go back out to the February calls and let's look at the 26.58. We'd have to call it. We'd have to call that. We'd have to call that 27. But it is a possibility. It's only $5. So what that looks like as far as money will be $10 for the 100 shares at 15, and then it'll be $30 on the sale of the 600 shares. And so that'll put $40 in our pocket today, and that will make sure that either we are going to simply just continue to hold our 500 shares, or we'll buy more, collect the dividend, and then potentially sell at a profit. So that's kind of what we're looking at. Whether or not the price will get down to 15, again, the only way that happens is if either we get back to some sort of, again, they would have to not only have a losing quarter, but the PE ratio would have to drop down to the COVID low as far as earnings go. And then on the book side, the only way for that to happen to get to 15 is that, again, price to book would have to be somewhere in the neighborhood of 0.65, which is crazy. And if that did happen, for sure, everyone is going to buy the heck out of that stock to run the price up. So, again, don't expect it to get down to 15. So more than likely, the option is going to expire, and we'll just keep that cash in our pocket. And then we don't even get a chance to average cost down our price, which means that we also don't get to profit from the option on the call on selling the shares in February. So with that being said, there's nothing really to do here other than maybe collect $10 on the off chance that the price does fall down to $15. And that's it. If we wanted to be risky here, we could definitely do something like $16 or $17. Again, with the understanding that the price is not going to get down that far. But again, I don't think $15, $25 is worth that risk. So I'm not going to do anything right now with Regions Financial. Just hold on to our 500 shares, continue to collect our dividend, and watch the price rise because I'm pretty sure that's what's going to happen. Till next time.